What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Last trading day of the year. Hope you guys are doing well. Hope you're ready for the new year. Have some plans with friends and family. We are just going to go over a few kind of odds and ends in the news cycle. There wasn't any huge news. Of course, there are some S1 filings from the ETF participants and that kind of thing. There's also, let's see, SOFR, which is a secured overnight funding rate that the banks use now instead of LIBOR. This had a spike. There's also a spike in the reverse repo. So we're going to talk about that a little bit. What else do I have? A few just odds and ends tweets. And then also this back and forth that I had today about cash creates versus in-kind creates for the ETF. And what is the actual difference? I'm not an expert there, but I follow the right people, I think, and been learning a lot over the last couple months about this very subject. So I will share what I can. For now, actually, let me pull up my website. Bitcoinandmarkets.com is where you can go to find all of my stuff. I did put out a podcast version of these live streams. So I usually I try to live stream 3 times a week. And then I turn as many of those as possible into podcast versions, but I don't always get, every week, at most nowadays I get one. I used to get 3, 4 a week, but now I'm only getting one out there. So make sure you're subscribed to the podcast versions because I do put out my best ones, I think, of the week. I try to choose the ones that maybe there was the most economic discussion or the most discussion about deep topics in Bitcoin, because this is primarily a Bitcoin show, but being an economist, I talk a lot about macro and all that stuff. So that's why it's Bitcoin and Markets. But anyway, have 2 different newsletters that I put out. A free one usually comes out on Mondays, and then Fridays or Saturdays, I get the professional tier one out. I also do blog posts over there. So just check out bitcoinandmarkets.com. Also check out bmpro.substack.com. That's this one here. I'm writing for Bitcoin Magazine Pro. I put out a double dashboard. We have 2 dashboards that we put out for them. They were designed by Dylan LeClaire and Sam Rule, and I took them over about a month ago now. But one is on markets. So on-chain metrics, we have technical analysis levels. We have cost basis, like for how much energy cost on average does it take to mine a Bitcoin, that kind of stuff. Then we also have a mining dashboard that goes through all the public miners, all details on them, following all of their releases of their monthly activity, and what else is on there? Hash price, revenue in dollars, revenue in Bitcoin, things like long-term holder, short-term holder ratios. All that stuff can be found on the dashboard. So check out bmpro.substack.com. And then once a week, I do put out a big one. So here is the one from last week. Bitcoin miner stocks primed for rally plus Bitcoin price update. And I had been following these miners. I wrote about 6 weeks before, 6 weeks ago now. And I said, hey, we should be watching these miners. They're about to take off. And then this came out last week. They had one final push, but today miners got shellacked today. We'll take a look at those charts. But the public miners probably will outperform Bitcoin for the year. They were so far ahead. They were up 250 versus Bitcoin's 150%. So they'll probably still outperform Bitcoin for the year. And I can just go through a bunch of other stuff. You can see tons of charts. We'll look at the live chart here in a second. So that's what you guys can get over there on bmpro.substack.com. Okay, let's go into this one first. All of these commercials are coming out for Bitcoin. The marketing budgets around the ETFs are really going to explode here in the next few weeks, going into the most likely approval on January 10th. And then the launch day being weeks to a month out after that. And they're going to be pumping the marketing. But this is the new one from Van Eck. So let's just watch this real quick. make sure I'm all set. All right, let's play. And Gabber, he's a Van Eck guy for a long time. He said, notice it says born to Bitcoin and not born to crypto. So yeah, Van Eck, they went for the ticker HODL for their ETF. They are the most Bitcoiners of this ETF batch here. But okay, let's move on to another video here real quick, if I can find it. Perry Ann Boring. I remember her in Bitcoin probably going back to 2014. Then she went on to Capitol Hill. She's been doing a lot of work with like Coin Center and education of people on Capitol Hill because she came from that world. She was somebody's assistant or something. And then she moved over to Bitcoin education on Capitol Hill. For a long time, I did not like her all that much because she is a crypto person, and you'll see that in this clip as well. But here she's specifically talking about, she went and talked to all those co-sponsors of Senator Warren's bill that she recently put out, the Bitcoin ban bill. And apparently most of those had no idea that this was actually going to ban Bitcoin. And so anyway, let's hear what she has to say. Is this the video? Oh, this is not the video. Damn, didn't have this set up. Let's go here. Play this. Oh my God, I got to allow ads. Well, that's not going to happen. So sorry, guys. Stand by 1 second. I'm going to go in to Twitter and find that video. But this is exactly what I was kind of saying early on was, one, this isn't going anywhere. Senator Warren, she has never really gotten any of her stuff passed. I think it's 315-0 to get anything passed from her. All right, here's a different one. I think this will work. All right, let's do it.
Perry Ann Boring is all asking, so I want to bring in an expert on the space.
Oh, this is bad sound.
Perry Ann Boring is the founder and CEO of the Chamber of Digital Commerce. Perry Ann, great to talk to you today. So I want to start with that Senator Warren backed bill. It is the Digital Asset Anti-Money Laundering Act. It has bipartisan support. It would crack down on the space by introducing a number of restrictions that traditional banks are used to, like know your customer laws. There's been a lot of pushback that this would destroy the industry in the U.S. So first I want to get your take. What could this mean for crypto?
Yeah, hey, Kelly, it's great to be here. So
I just mentioned crypto, these people, I don't think this chick on the left is doing that intentionally, but that just shows you how early we are.
Senator Elizabeth Warren has misled the American people as well as the U.S. Congress on multiple fronts. First, she's misled us to believe that crypto has an AML problem. It does not have an AML problem. The vast majority of illicit finance goes through the traditional financial system and legacy banking infrastructure. It's not happening in the cryptocurrency space. And the reason being is because every single crypto transaction is logged on a public ledger called the blockchain, and law enforcement has greater tools to track and trace on a blockchain than they do on legacy infrastructure. So that's misleading claim number one from Senator Warren. Number two is about her bill. This bill was introduced under the guise of anti-money laundering to fix these non-existent compliance gaps for crypto. She has misled the U.S. Senate, and now 20% of the U.S. Senate is sponsoring this bill that they think is going to address a compliance issue.
That's a good point. And, I was saying that she's just trying to move the Overton window. She's just trying to give a thesis and antithesis, isn't it? And a synthesis, the Hegelian dialectic. She's trying to move it in a direction. And even if she can only move it 5-10% in a certain direction, that was Senator Warren's goal. To fight that kind of thing, you pretty much had to say, no, you're lying. And that's what Perry Ann is doing. So I think that this is a good job what she's doing here.
Issue. But if you read the legislation, you'll quickly understand that the requirements are technically impossible to implement in a blockchain-based environment, making it illegal for U.S. persons to use this technology, which effectively bans it for U.S. persons. This would be absolutely detrimental to our space. The false and misleading statements that have been perpetuated by a sitting member of the U.S. Senate, Elizabeth Warren, must be taken seriously, and the Senate Ethics Committee should launch a full investigation on this as well.
So, Perry Ann, I also want to get your take on this. So one of the crypto bill's sponsors, Senator Roger Marshall, he was explaining last week what the bill's purpose was. I'm going to play some sound, and then I want you to react to it. So again, this was Senator Roger Marshall.
Senator and I authored the Digital Asset Anti-Money Laundering Act that represents a step in the right direction. Again, I think that this is a light touch. The first thing we did is we went to the American Bank Association and said, help us craft this. And I don't know if you saw Senator Warren's hearing with Jamie Dimon yesterday, but Mr. Dimon said basically, in his opinion, crypto is only a tool for criminals.
Okay, so my first thought here is the American Bank Association. I mean, they went to them to craft this legislation. They're known as being very anti-crypto. What is your thought about the fact that you have these two folks working together with something that would impact the entire industry?
We have met with all 19 Senate offices that have sponsored this bill. Many of those offices were shocked to understand that this bill that they signed on to actually bans the technology altogether. This video of Senator Roger Marshall, he calls it a light touch approach. Clearly, either he doesn't understand or he's misrepresenting. How is something that's a ban a light touch? And it was very shocking that he also shared publicly that it was a bank lobby that wrote this bill. I think it's very important for the American people to understand that cryptocurrency as well as Bitcoin is going to disrupt the $2 trillion transaction fee industry that the banks largely benefit from. This is going to disrupt legacy systems, and this is a fight as old of time. You had, the taxi drivers didn't want to see Uber, Blockbuster didn't want to see Netflix, the banks don't want to see Bitcoin, which is fine, but then to have a U.S. Senator give false and misleading statements, not only about the bill, but about the technology itself, is incredibly serious.
Well, it is important context to know who.
I mean, that's what they do, right? Politicians lie constantly. That's all they do for the most part. I mean, every once in a while you have a good politician, but 99% of politicians, all they do is lie all day long.
Who is behind that, the stakeholders, what their motivations are. I do want to push you on something, though, because this is a space that I've been reporting on a bunch with the Binance enforcement actions with Sam Bankman-Fried and his trial, certainly two very different cases. But one of the things that people are worried about, as you said earlier, is potentially terrorists using this cryptocurrency. There's a lot of nefarious, sort of brand associations with crypto. You mentioned that the actual transactions happening on the blockchain creates a level of transparency. But one thing that does concern me is you can actually transfer a Bitcoin or a crypto, maybe it's not Bitcoin, from one country to another instantly. That's one of the attractive aspects of Bitcoin, of crypto. But you could be transferring from one country that has one approach to crypto, one approach to money laundering, to a country that has more favorable outlook and laws when it comes to that. So what is your push? If it is not this bill.
Okay, I didn't actually watch this part, but just to respond there, she's saying that you send Bitcoin cross-border. That's not how Bitcoin works. Okay. Bitcoin exists everywhere there's a node, because every node has a copy of the blockchain. And the only thing that you send is, or you don't even send anything. You unlock it so that a different signature controls the Bitcoin. But the Bitcoin itself never moves. It never moves. All you're recording is that it switched ownership. It's kind of like if you had, uh, it's hard for people to grasp this, but if you had a vault in a centralized country and you were using that to back your money and you were doing electronic transfers and you're just reallocating that gold that's in that vault that backs all the dollars, you're not sending the money anywhere. But now think about of that vault being decentralized, and there's actual vault, exact same vault in every single place there's a node, and all those nodes are doing is keeping track of what belongs, to whom. There's no actual Bitcoin going across the border. So all of these arguments are wrong on their face. I don't think we're going to get there yet, but at the rate that people are learning about this, especially lawmakers and things and bankers and wealthy folks, I bet they'll be at that level of understanding within 10 years. And then we won't have to deal with all this stuff because they're going to have to come up with, well, first off, Bitcoin doesn't fit into any of these existing frameworks, really. So another thing I said when Senator Warren's thing first came out, or when she was saying that they need to comply with all this AML stuff, I mean, those types of like AML requirements, they don't really apply to cash transactions. I mean, maybe very large cash transactions, if you're spending $10,000 on something in cash, you should get to know your customer in that case. But those type of regulations don't apply to $5 transactions where I use a $5 bill. So Bitcoin is electronic cash. It's not even like it's just hard to apply the old definitions to this new thing. The only thing you can apply to it is cash, treating it like an actual cash, actual coin, that type of thing. So all of these digital money transmitter laws, they should not apply to Bitcoin, in my opinion. But yeah, let's see what Perry Ann has to say about that, about transacting internationally.
In order to crack down on something like that, when we have such different approaches globally right now, as the outlook and this industry is evolving, what should we be doing instead?
Of these 19 offices, Senate offices that we've met with, a lot of them were also shocked to learn that cryptocurrency exchanges are already regulated as financial institutions. This is another misinformation. There's been a ton of disinformation about this technology and about the companies working in this space. Cryptocurrency transactions are already regulated. Exchanges where you buy and sell cryptocurrency are registered with.
Yeah, and like big companies in traditional space go down all the time. Look at Silicon Valley Bank. Was that bigger than FTX? It was at least the same general size. Signature Bank. Those things go down all the time. These traditional system banks, traditional system companies, Lehman Brothers, AIG. So it's not a Bitcoin problem. It's a Ponzi-nomics problem.
FinCEN at the U.S. Treasury, and they are required to have anti-money laundering programs in place, including know your customer regulations. Several years ago, this is an international standard as well. The Financial Action Task Force, or FATF, put together anti-money laundering regulations for cryptocurrency businesses, and those are in the process of being implemented internationally. So this space is heavily regulated. Cryptocurrency exchanges are doing Know Your Customer, are required to have AML compliance programs in place. And again, cryptocurrency does not have an AML problem. Illicit finance is not happening in the crypto space. The vast majority of it, over 95%, is happening in the legacy system.
Boom. Okay. I thought that was pretty good. So that's the other video I have for you guys today. Let's take a look at some ETF news. So everybody had a deadline of December 29th, last business day of the year, to refile their S1s. And again, I'll say I'm not a super expert in this, but Eric Balkunas is. So he said earlier that there's going to be it's going to be a two-phase approval. So the first approval will be their 19B-4, I believe is the form number. And that is for a rule change. They have to apply to get a rule change so that they can get approved. Then the second half of the application is this S1, and that goes into the details, the nitty gritty of the financial transactions, the financial plumbing within the ETF. And that has to come into compliance as well. From James Seifert and Eric Balkunas in the past, from what I understand, is it can be weeks to months between these two approvals. The deadline on January 10th is the deadline for the rules change. The S1 deadline, there isn't really one. They might all do both at the same time, and that's why they want to get all this stuff lined up and all their T's crossed and their I's dotted, but it doesn't have to be. And that's why I was saying, okay, well, if they do the rules change January 10th, by February 10th, they'll launch. Most likely it'll be within a month of the approval that these things will all launch, and they probably will launch on the same day. That is my guess. But from Eric Balkunas here, he says BlackRock just dropped its updated S1 and does name the APs, Jane Street and JP Morgan. Okay, so JP Morgan, of course, is Jamie Dimon's bank, and they crap on Bitcoin all the time, but they are going to be the, what is this, approved participants? What's the AP stand for? But anyway, they're going to be the ones that stand between the market makers and the actual ETF. Those are the APs are the ones that kind of facilitate the buying and the selling, the redemptions and the creations. So let's take a look at this, if it will load. So it's authorized participants. Authorized participants are Jane Street and JP Morgan. These transactions will take place in exchange for cash, subject to the in-kind regulatory approval, blah, 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 blah. So very interesting. BlackRock named their participants. I don't think anybody else has named theirs, but they are wanting to get this going. They want their S1 to be approved ASAP after the rules change is complete. And they're making sure that happens, that they are first out of the gate. Of course, BlackRock is extremely experienced in this, and so they know how to line up all of their paperwork to get the fastest approval. I would just be copy and pasting a lot of this stuff from BlackRock if I were people like ARK or some of the smaller applicants, because BlackRock definitely knows what they're doing here. So, okay, let's go on to something related. And this was a tweet that I had. I can't remember when I sent this out, yesterday or something. And I said that the SEC requiring cash creates will have unintended consequences. And what I meant by that is that, central planning never works. And they're really pushing for this, I believe. So I had another thing here. Let me see if I can go in here. Oh boy, I should have had this all lined up here. Okay, here we go. So, in my opinion, this cash creates thing is a compromise between anti-Bitcoin interests in the administration and I've covered this on the global Marxist angle versus Wall Street. So they are in charge of the SEC, and they don't want this to happen. They are the Senator Warrens. They are the Janet Yellens, the Joe Bidens, the von der Leyen's over there in Europe, these globalist WEF types. And they are going against the powerful pro-Bitcoin interests within the elite clients on Wall Street. So BlackRock isn't doing this because BlackRock wants to do this. BlackRock is doing this because they have some billionaires that want to do it, or mega millionaires, lots of them, lots of interest in this from their clients. That's why they're doing this. And so they are on the pro-Bitcoin side, Wall Street, and they have built an undeniable case for approval. They went to court. There have been years and years of applications. They fixed all of the objections from the SEC, previous objections, the ones that didn't get worked out through just time, making the market more robust. They have been worked out by the court case, the Grayscale court case, where the judges, the panel of 3 judges unanimously found that they could not follow the logic of the SEC, that they will approve a derivative product, the futures ETF, but they won't approve a spot product, which is backwards. It's absolutely backwards. So yeah, the Wall Street, the elite clients for these big wealth managers and stuff, they are pushing for this, and they have built an undeniable case for approval. So then comes the compromise. Let's not do in kind. Let's do cash creates. Cash creates puts a little bit more, causes a little bit more pain on the issuers with accounting requirements. We'll go through that here in a second. And it also can complicate things for large holders. So, you are exposed to income tax or to capital gains. When they distribute capital gains, that counts as income if you're a holder of these ETFs. But that wouldn't be the case if it was in kind. So it does makes it more complicated and puts some, dirt into the grease or the wheels of this ETF launch. But okay, let's go back here now. Okay. So there's this guy, Cam, and he was asking some questions, and not very often do you get interaction on Twitter. Usually it's either trolls or people just liking your stuff or retweeting your stuff. And at least for me, it's hard to find normal, neutral, positive interaction. But he asked some questions here. So it feels like he's just being vague, posting, okay, he's talking to me. And so see, I thought this was trolling at first, but I went ahead and responded. And I said, it's not that hard. Some marginal demand for in-kind convertible products, like all other commodity ETFs, will not be met by the cash creates product. So if you want to invest in an in-kind ETF and not deal with all of the complicated tax implications, you're going to go somewhere else. You're going to go to Canada. You're going to go to Hong Kong. Or you're going to go to OTC, you're going to go to some sort of custodian, whether that be Coinbase or Gemini or BitGo or something, and you're going to have someone else just hold your Bitcoin for you. So this ETF, I think that cash creates is going to have a backfire effect, because it's going to push some people, not all people, but say 5% of the high net worth individuals, it's going to push them into other products. It's going to diversify exactly the opposite way that the SEC wants. The SEC wants to centralize it, centralize all of the buying and selling and holding of all this Bitcoin for these ETFs. And by requiring that, they're actually going to accomplish the opposite. That's why I said it's going to have unintended consequences. But okay, let's go through this a little bit more. He said, okay, I just wanted to find something, so we're on the same page. Even with in-kind redemptions, only the authorized participants can redeem shares for BTC. Beneficial holders, I don't know what he means by beneficial, but average retail holders can't redeem shares for BTC in either configuration. And I say that is generally the case. However, the authorized participants deals with a market maker who has their own processes. In-kind offers significant cost savings in regards to cap gains and other tax events. And I went ahead and sent this image. Let's see if I can zoom in on this. I don't think I can. Damn. That's not going to help, is it? No. Okay. Well, this top section here is the in-kind redemption model. These yellow ones are the market makers. The top is the ETF exchange, and the bottom is the Bitcoin exchange. Down here is the Bitcoin custodian in blue and the ETF issuer. So you can notice there's a lot fewer lines here. And in this they go through the steps for each one of these. And in this, they say, you know, the market maker can sell, or they can hold, or they can do whatever else they want with their Bitcoin. It doesn't say they can do whatever else they want, but, you know, they don't have to sell into the market. The market makers can sell to OTC, to somebody else probably. You know, so if you want to redeem Bitcoin out of an in-kind ETF, you could deal with the market maker, the authorized participant. But you can't do that with a cash create, because a cash create, they're buying and selling with cash. You can see that there's a lot more lines down here in the cash model. Okay, so let's talk a little bit more about the taxes. So he says how these mechanisms mean nothing to the holder in terms of cap gains, as far as I can see. All right, here we go. So if the issuer sells Bitcoin, so the ETF issuer, BlackRock or ARK or Van Eck, and they sell the Bitcoin, they in a cash create, they have to sell it for cash. And then they realize, the issuer themselves realizes a capital gain. So if Bitcoin doubles, then they want to have some redemptions. They sell the Bitcoin. They get a capital gain on that, and they distribute it. They have to distribute it to all their holders in a capital gain distribution. But that capital gain distribution, that counts as income to the holders. So back here where he says that the mechanism doesn't have anything to do with the holders. Well, yes, it does, because they get income from a cash redemption. They wouldn't get this with in-kind. All right. Granted, this will be small for the average holder, maybe $25 to $100 per month. And we got those numbers from Grayscale distribution. So Grayscale has to give distributions weekly, monthly, all that. And they average, not very big for the average holder. But it could be, say, $100, or I don't know, if you own $100,000 worth of this ETF, it could be $1,000 a month. I have no idea. That's significant when you're talking about taxes. Okay. And can be reinvested in most cases, I think. So you can reinvest this. You don't have to take the distribution. You can roll it back into your investments most of the time. I think you'll be able to do that here with Bitcoin. But if you don't, if you require to take that, then you're going to have income. You're going to raise your tax liability because your income goes up. And then perhaps you have to sell some of your shares to pay the higher increase in tax. So let's say you made $20,000 off of this cap gains distribution, and your taxes now go up by $5,000 or $10,000 even. So then you have to go and sell the shares to cover that new tax, to pay for it. So there's a vicious loop here that's involved. But for most people, it won't be that big of a deal, because it'll be $25 a month or so, whatever. But if Bitcoin does spike by 20x, which I think a lot of these issuers think will happen over the next few years, that could be significant. Now you're talking the average person, the average holder might be getting $1,000 a month off of these type of things. I don't know, but it makes it more complicated. It complicates issuer and holder accounting and taxes. In kind doesn't have to deal with this. So it's obviously more efficient. And I say also down here in the next one, and that is why all commodity ETFs use in kind. Bitcoin will be the only commodity ETF that does not use in kind. It's crazy. And I think it will change. I think they'll sue. These issuers will sue, and they won't, and they'll be allowed to change it. Okay, last thing for the day. Let's take a look at this one. This is from Zero Hedge. So SOFR suddenly soars to record high as key funding spread hints at imminent liquidity crunch. Now, this caught my eye because, well, one, SOFR suddenly soaring. That's important. But also that liquidity crunch. So we're told that we're going into an era of higher liquidity. That's one of the things I've been kind of pushing back on over the last couple months. You can look at people on Twitter. You can look at, there's a lot of people that have built indicators for TradingView as well. That's like net global liquidity. And it's based on certain metrics and stuff, and it's going up. But it's exactly wrong. They're measuring the wrong things as liquidity. And you can see here, liquidity is in a crunch. When yields are falling, guys, on the 10-year, on the 2-year, on all these, on all the treasuries, when it's falling, that means money is getting tighter, not looser. Liquidity is not getting greater, it's getting less. And people are narrowing where their money is going. It's going into the Mag 7, the Magnificent 7 on the stock market. It's going into bonds. It's going into safe havens. That's why we'll go into Bitcoin. Okay, so let's read a little bit of this. Over a month ago, and well before the Fed's shocking dovish pivot. We went over that twice on the live streams here. There was no shocking dovish pivot. It was kind of an off-the-cuff remark that Powell made and was tried to be instantly walked back by other members of the FOMC. There was no shocking dovish pivot, guys. As the Fed's overnight reverse repo tumbled below $900 billion for the first time since June of 2021, amid a growing debate of where and when the Fed's reserve scarcity constraint will be hit, we warned that liquidity is rapidly approaching the reverse repo constraint level, which could emerge as soon as the RRP facility dropped to $700 billion, at which point the market's all-important credit plumbing will start to crack. I don't think so. We had a jump in SOFR. Okay. Notice when these jumps were. Can I bring this up? Okay. Notice when these jumps were when they tend to happen. They tend to happen around the end of quarters. Q1 was this one. And the end of the year for this one. End of the year financing squeeze. Oh, wait, I wasn't even on the right tab here. Sorry, guys. The end of the Q1 right here with the banking crisis with Silicon Valley Bank and Signature Bank, and then end of year here. These are just end of quarter squeezes for this stuff. Okay. I thought I had brought up a different article that showed this differently, but I don't see it now. So I'm going to go to Zero Hedge and find the second article. Hold on. Here it is. Okay, so Zero Hedge. Treasuries tumble after 1 trillion reverse repo drains 190 billion in liquidity index change. Earlier today, when discussing the sudden spike in SOFR to an all-time high, 5.4%, that wasn't an all-time high, which dragged the SOFR Fed funds spread to its highest since March of 2020 repo crisis. We said that the two factors are likely culprits: the year-end liquidity crunch, that's what I'm saying, and the recent sharp increase in the Fed's reverse repo facility, which has increased from multi-year low. Okay, now what's the reason behind this? And I want to bring up, actually, let me go to Fred database and look this up. Come on, reverse repo. Okay, so this is the reverse repo facility. If you go to all of these spikes, this is the December 30th of last year. Look at that spike, okay? End of year spike. This spike, when was this spike? September 30th, end of Q3. When was this spike? June 30th, end of Q2. You can go through all of these spikes. They always have, here this one's Friday, December 31st of 2021, end of year spike, end of third quarter, end of second quarter. Even these, if you go back in history, so if you go back, because reverse repo is not new, but if you go back in history, all of these spikes are end of quarters. What's that all about? Well, it's because the end of quarter crunch. That's exactly what we're seeing here. This will go down immediately. January, the very next day, it's going to be down. January 2nd, January 3rd, whatever is first trading day of the year, that it's going to instantly fall again. Why does this happen? I'm not sure. I think there is stuff about they don't want to carry certain trades. So like, let's say a client of a bank, they don't want to carry trades into the new year. They want to close their trade. Well, now they have some cash from closing their trade and it goes into the bank. And then the bank goes into reverse repo so that they can harvest that little bit of interest. That's what I'm thinking is happening here. It has nothing to do with like a change of direction, a change in the level of liquidity, or anything like that. It's just the end of year, end of quarter, typical movement of money. And I think that's pretty significant. So let's see, if you go down to this low here, it was 683 billion and it jumped all the way back over $1 trillion. So that's over 300 billion in just a few days. That's about how much is, if you think of it this way, that's about how much is like constantly moving through the plumbing overnight that has to find some place to go. And when you have a plumbing clog, contagion in collateral markets and in repo or whatever, you're looking at 300, maybe 500 billion, maybe even $1 trillion that instantly freezes and backs up. I think the total global repo market is like 5 trillion a night, at least in the West. And then if you include, Asian countries like Japan and India and China and all that, that's probably another 5. So it's like 10 trillion a day that's going through these reverse repos and repos all over the world. Most of these repos are not from the Fed. I mean, the Fed does a very tiny amount. As you can see, if we zoom out and we look back here in like 2014 and stuff, they were doing 100 billion, 100 billion, 100 billion. Globally, they were doing trillions. So the Fed is really just they are a part of this market as an influence, as a warm fuzzy, a comfort blanket. That's what the Fed does here in the market. All right. So that is it for that one. Let's see do I have anything else to go over? I don't think so. So let's go back to bitcoinandmarkets.com. I'll take a look at the comments. Ponzinomics. Yeah, I actually tweeted that Dex earlier today too, because Vitalik finally tweeted something with the term Ethereum. Let me pull that up. He hadn't tweeted about Ethereum in like 3 months or something. And so people were waiting for him to do that. and he finally said, hey, we need to make Ethereum cypherpunk again. Let me find that. Here we go. Bringing it up. So Vitalik said, make Ethereum cypherpunk again. And I say, ETH, they traded off decentralization for pump and dumps, sound economics for Ponzi-nomics. There is no going back. Best to jump ship and buy Bitcoin. So yeah, that was, it reminded me way back in the day where a lot of projects in, like, say, the ICO phase, or maybe even in the altcoin phase prior to that, was they say, oh, we'll decentralize later. We have to launch, make sure everything's working. And then phase 2 of our project is to decentralize. Of course, phase 2 never comes, because you can't just launch these things and then decentralize later, because it's impossible pretty much to go in that direction. The incentives are structured in a way, you have now ingrained the incentives of a centralized system, and you can't unwind that and decentralize later. So you have to start from decentralization, and you have to make maintaining the decentralization pretty much your prime directive. Ethereum didn't do that. They started centralized from an ICO, an unregistered securities offering, and they continued with every hard fork. They continued to centralize more and more. There was this thing that Vitalik said early on in Ethereum. He's like, oh, we're going to train our people, our nodes, to hard fork by doing it to them all the time. Like, they hated their people. They hated their nodes. It's a different mentality. They say, oh, we're going to hard fork a lot so that people can know how to update, and they get good at it because they had a lot of practice. But every time you do that, not only are you launching a new coin, which I think is a taxable event, but that's one of my more niche ideas. It is a taxable event, a hard fork. But every time they hard fork, they centralize a little bit more. And they did that so that they could have these pump and dumps, so they could be programmable, so they could have all of these different, I guess, smart contracts and the Ethereum virtual machine, or whatever it's called. They kept doing this over and over so that they could create this environment for Ponzi's to be built on it. And so they traded decentralization and sound economics, and now I could say sound incentives, for pump and dumps and Ponzi-nomics. And they can't go back. It's over. But speaking of that, let's go and check out live charts here. And I'm going to double check, make sure. Yeah, if you guys are watching on YouTube or Rumble, make a comment down below and I'll get to any questions. If you are on Telegram, I will be looking at the post for this live stream. But okay, so here is the Bitcoin chart. We're kind of falling out of this triangle, but we do have time to turn it around. If we go back and look at this triangle, we had a couple times where it did close outside, or at this one, it did close outside this triangle. Very similar position too, a bit over 50% through the triangles when it fell out, and it came back up. So we'll watch this. I think I was mentioning on Telegram before we went live on the other platforms that this could be people selling the news a little bit early, because it feels like the ETFs are a done deal, doesn't it? It feels like it's a done deal. So I think maybe people that are waiting for this to be a sell the news, they are selling the feeling that this is a done deal. And all of that could push it down to 42,000. So anyway, we'll see if it can rise back up, or if we do, if we fall down here, we have the 50-day right here. There's some other things that are emerging or that have consolidated around 40,000 for support. Let me see if that is from the weekly. I can't remember all the different levels. I'd have to go back and look at my other charts that I published, but there is quite a bit of support around 40,000. Of course, 37,000 here. So any sort of dip, sell the news. I don't think it's going to be getting past 37,000 and probably not past the 50-day, but we'll have to wait and see. If we zoom out here a little bit more, you can see my possible launch right here, possible banking crisis, and halving. So we have some events coming up, and they're all relatively positive for Bitcoin. Remember, back in March, during the Silicon Valley Bank and signature, we'll zoom out and we'll go to that one. Let me take those off. So this big jump here was last March's banking crisis. So if we have a banking crisis at the end of Q1 again, we're going to see something similar to that, I think. Plus, of course, the ETF launch is very, very bullish because there's going to be a lot of buying of Bitcoin. And also the halving is very bullish. So these next few months are going to be one wild ride. Let's take a look at the miner ETF. So this red line is when I first wrote about it on Bitcoin Magazine Pro, and had a nice huge rally from there. It was overbought significantly. So that was pretty obvious time to start paring down there. Something similar happened back here in July, and it did have a pretty significant consolidation and downtrend all the way through October, and then it went back up. We will see. I think Bitcoin is going to outperform miners in 2024, but miners outperform Bitcoin in 2023. All right, let's move on to some other ones. US 10-year. I think we probably hit a temporary bottom here, a swing bottom, and a lot of people are, they just follow with the wind. And as soon as I see people capitulating and saying, oh yeah, now yields are going down. Oh, look at what the Fed did. Yields are going down, guys. They're going down sympathetically to the shockingly dovish pivot from the Fed. Then I know it's probably getting close to that it's going to reverse, because most people, especially most macro pundits out there, are idiotic. And if they're all jumping on board with these lower rates, then it's probably going to be a temporary shift here. So I do think that we could rally a little bit here on the 10-year in yields. Of course, that means the price of bonds will go down. But overall, I mean, if you look at this for out to next June, I do think rates will be significantly lower. Okay, what else? How about the dollar? The dollar had a massive sell-off. And when I was writing about this to the Bitcoin Magazine Pro guys, I was like, man, I have thought that it was going to strengthen a little bit here. But if you go back and you listen to some of my content from, say, 2021, I was talking about it coming up, the dollar getting stronger, and then being range bound. Let's zoom out here and take a look at that. Let's go to the monthly chart. And you can even see my range here from the last time. So pre-GFC, it was stuck in this range for a long period of time between, say, 70 and 85, right? It was stuck in this range for a long time. Then it popped up in about 2000 and end of 2014 into early 2015, and it was range bound here for a long time, all the way till COVID, through the first part of COVID, through 2021. This was range bound. And so I thought that my expectation was that we would enter some higher range up here, and that would go on for a long time. I think I was talking like 105 to 120, and we just never really quite stabilized in that range. I think that was a little bit too strong for the rest of the world, but maybe we're in this range, if we come down here, so between 100 and 112, 114, 115, and we just bounce around in this range for several years. I could totally see that for the dollar. That's the way the dollar is going to die, guys. The dollar is not going to die from a hyperinflation. The dollar is going to die from getting too strong. And they're going to have to devalue it. So most likely, like a lot of people out there, I saw a lot of tweets today, and people were talking about, oh, there's going to be the dollar is going away against Bitcoin. Bitcoin is going to cause the dollar to die and yada, yada. No, it's not. Okay. The dollar is not going away. The dollar has a superpower. Okay. You can back it with stuff. So if it gets too crazy, I think it's going to get too strong, to be honest with you. But if it gets too crazy, they can simply back it by something. If it looks like the dollar is going to die, do you think the powers that be are just going to sit there and watch it die? Hell no. They're going to back it with something. So Bitcoin and the dollar right now are competitors, but eventually they're going to be the same thing. The dollar will be backed by Bitcoin. And this is not strange or out of the blue or unknown by all these people. I mean, everyone, I see this chart all the freaking time about world reserve currencies, and they only last for 75 to 80 years. That's BS, people. That's BS. Because it was not the guilder, it was not the livre or the sterling. Those weren't the actual money. Those were just the currency on top of the money. And the money was gold. Or prior, if you go back to like the Spanish peso, it was silver from, well, first, okay, let's go back. For 1,000 years, it was a gold standard in the Mediterranean and in all these trade, the long trade routes that went, connected Northern Africa, the Indian subcontinent out to China, Europe, the whole Mediterranean basin and stuff. That the unit of account was gold. Then when the Byzantines, they devalued their gold coin so much that they stopped producing it. And then the Italians took it up. So the Italians created their currency. I'll just go to that post. Okay. So here is the history of world reserve currencies, and I'm talking about the Italian Renaissance standard. And this ran from 1250 roughly to 1535. It was a gold standard. So the Florentine florin and the Venetian ducat, they were almost exactly the same coin. I think they were, let me see the weights here. I mean, it doesn't really matter because they were, okay, so the ducat was 3.545 and the florin was 3.5368 grams. So almost identical. But that doesn't really matter because the money was gold, okay? Then in about 1535 is when the Spanish peso became pretty much the money, and that was silver, right? And so then silver was the money of the world until just before 1800 when the British sterling switched back to a gold standard. So all this talk about 75 to 80 years for a currency is just talking about these like individual flags. It's not talking about the money, like gold, silver, then gold again. Those things take about 250 years to go through a cycle from gold back to silver back to gold. And now it's going to be Bitcoin. But the dollar can simply be backed by Bitcoin. It's not going to go away. Okay, blah, 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 blah. Let's go back to the charts. So that's the dollar. We'll see how that goes. Let's look at oil. Oh, come on. I got to take it off of logarithmic. So oil has pretty much followed this arrow that I drew the other day, and I drew that because of the 50 and the 200-day moving averages having a death cross. Usually things rally into their crosses. You could see, or fall into their crosses. So you can see the price here back in August fell into the golden cross. Then the golden cross, it went higher. And here it rallied into the death cross, and it has since sold off. I don't know how far down this can go. I don't think that oil is going back to 40 or anything, but I could see it getting into the 60s, into the low 60s even. There is this support that has held up here. The U.S. has said they're going to start buying to restock the Strategic Petroleum Reserve. So I don't know at what levels they're going to be doing that. Maybe they're doing it now. I think they are doing it now, kind of slowly. But if it gets down to 65, they're going to be sucking that up and putting it in a Strategic Petroleum Reserve. So that's kind of the floor, I would say, is this structural support area around $65. Okay, let's take a look at stocks. They didn't have as bad a time today as the Bitcoin miners, but let's take a look. So these marks are the October CPI surprise had a gap up, and then this is supposed to be the shockingly dovish pivot from Powell, which wasn't really a pivot. As you can see, people will start up here at the top and they'll say, oh, it's all because of the Powell pivot. It's all because of liquidity leaving the reverse repo and going into the stock market. Instead of where were they back here? I was calling for a bottom at the end of Q3, which didn't quite make it. I mean, it looked like it was going to work here for a second. Then we had one more push down, and now we're going up. But I did call, my 2023 call was for the stock market to go much higher, and it has definitely done that. So, okay, it is down a little bit on the day, but not significantly. Looks like 0.28% negative. That all-time high is right there in the red. Another thing, guys, if you go back and look in the history of the recessions in the stock market, recessions start near the top. I'll just throw this on here if I can. We'll go to a weekly chart and we'll pinch this down. I'll try to make this bigger. I mean, 2020 is kind of an extreme case because it was COVID. But look at that. The recession started right at the top, right? But if we go back in time, let's look at the GFC. It wasn't exactly at the top, but it was close to the top. October was the top, and then December is when the recession officially started. So recessions happen just after the top. All right, let's go back to the next one. Now, .com is the one that's a little bit different because it was, heavily about the NASDAQ and about stocks, but this recession started in March, and the top was, we could say, August. So that was, 6 months, 7 months, but still it's within 7 months of the top. Okay, let's go back to the previous one. Here in 1990, right at the top, that's where the recession hit. The early 80s recessions are a little bit weird because they were so close together. This is like the Volcker recessions, But you can see that this 1981, okay, I'll give it to you, that the top was actually way back here. well, that's 73. So that can't be. I'm thinking like 2 years beforehand. So it was at a top, and it fell. Then it was at a top in November of 80, and it went into recession August of 81. So that's a 7-8 month difference. Okay. But it's not 2 years. Same with this one. It started in 73, November 73, and January was the top. So that's an 11-month one. But now we're starting to get back in history. 50 years ago, yeah, the market was a different place. Okay. The way the stock market worked was a lot different than the way it works today with passive investing and mutual funds and all these ETFs and all this stuff. So let's go to today. Where are we? Geez. Okay. So when people were talking about, like, back in April of this year or something, that we're going to be going into recession, as the year progressed, I was like, you know what? We're too far away from the top. We're too far away from the top in January of 2022 to go into recession. If there was going to be a recession, should have occurred, right here. This is where the recession should have been, but it didn't. And actually, nominal GDP was at 10% during that time, if you remember. So we definitely were not in recession then. So no, then as we get closer and closer to the end of Q3, I'm like, we're not going into recession because it's just too far from the all-time high. This has never happened before.
Are you almost done?
Yeah.
Okay, because I don't like being.
Okay, I'm live, dude.
When are you gonna be done now?
A few minutes.
How many? Like 2?
Sorry about that, guys. My boy came in here. So they're off of school, obviously, for break. So I'm going to have to wrap this up here in a few minutes. But yeah, we were too far away from the all-time high. And I'm like, it's just not going to go into recession this far away. We're going to go to new all-time highs first. We're going to go to new all-time high. Then it's going to top. Then we can go into recession. So, new all-time high, somewhere like this. Then we go into recession. This is where the recession starts, not back here. So anyway, that is that. Let's go back to the Bitcoin chart. Under 42,000 right now. We'll see if it can get back into this triangle, into this bull flag. I mean, it still is kind of a, let's get the triangle tool out. I mean, you still could say it's forming a triangle like this. It doesn't have to be a ascending triangle. It could be a equilateral triangle or whatever, but Bitcoin does like to triangle. We'll see if it can get back in to here and be pushing up as we approach D-Day for the ETFs. Of course, there's going to be a lot of volatility at the last day of the year because of people having to sell, people having to balance their books, people having to move money around. So there is always going to be more volatility like this at the very last hours of the year. So, okay, let me take a look at the chat here real quick. What's up, guys? Doug says, yo. All right, let me take a look at the Telegram. No comments there in the Telegram. All right, well, that's going to do it for me today, guys. Thanks for joining, and I'll see you on the next one. Bye.